Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically it would be Michael Becker sitting here with me today, but he is closing another transaction. So we have Hans Box in the podcast. Hans is also with Old Capital down in the Austin, San Antonio market. So Hans and I were talking about some different alternative in commercial investing in and around the area. And I said, Hans, could we get maybe you and your partner into the podcast and talk a little bit about self-storage? Now, Hans, as you know, is a loan officer for Old Capital, focuses on many different property types, but he is definitely an expert on self-storage. So we brought Doug Wilson in today, his partner, and talk a little bit about why they got into self-storage, because they did a little bit of multifamily in the past. They actually still do multifamily, but I want to kind of focus in and educate everybody a little bit about why self-storage. So I got two of the smartest guys in the room here today. Doug Wilson, sometimes I may reverse this one. He went to Northwestern for his undergrad and Stanford for his master's. And then, of course, Hans Box is a Texas A&M graduate and also a CPA. So I got two of the smartest guys in the room to give you some education on why self-storage. So Doug, thanks for being in the podcast today.
Thanks for having us.
So Hans, if I can just borrow your head just for a second here, tell us a little bit about what your history is on multifamily and then also then transitioning into self-storage and multifamily.
Well, we started out investing in multifamily as a business partnership about 3 years ago. We did a couple deals with local deals here in the DFW area, and those are still ongoing and doing well. And as we've grown our partnership and grown our investor base, we started looking for other alternative investments as we saw the multifamily space getting harder to find good deals. Not that there aren't good deals, but we were having trouble finding deals, and our investors were hungry for yield. And so we branched out into a couple other areas, one of those being mobile home parks, and then the subject of this podcast, self-storage. And we started looking at self-storage mainly because of what we had heard about on the cash flow side of self-storage. We concentrate heavily on cash flow. We're not looking for home run deals. We like the singles and doubles and getting that strong double-digit cash flow for our investors. And self-storage was a possible opportunity to do that.
All right. Now, Doug, are these self-storage investments that you're making, are they like broken slot machines?
You know, when we started in multifamily, we saw some pretty bad properties, right? I mean, we used to walk in and anytime we saw something in terrible physical condition, that was like, to us, it was beautiful, right? It was the look of opportunity. And many of the deals that we bought early on really did look terrible when we got there. Yeah. And we were I was a little bit surprised, at least on self-storage, to see that there are some similarities there. That, you know, the very first opportunity that we bought, you know, we drive up to this facility, and it wasn't an old facility. It was built in the 2000s.
Yes.
You know, it was 10 years old, maybe 12 years old. And, you know, we drive up to the property. It hasn't been painted. And in Florida, when you don't paint a property for 12 years, it starts to actually look a little worn out. Mm-hmm. We noticed one of the differences with self-storage is that the management typically lives on site and the apartment is typically above the office. And in this case, you know, we drive up and we see a window broken. It looked like it had been broken for some time. In the manager's office, we walk into the lobby of the office and we see oil stains on the carpet. We see disarray. They were bringing packages in and putting them, you know, for tenants and putting them in the lobby, so it was really cluttered. There was a couch that had it was, you know, terrible condition, sure. You know, and it just looked really downtrodden. And we drive around the property, it hadn't been painted. There's rust, even after that little time, there's rust on some of the doors. And it, to me, was like the look of opportunity again. I mean, we looked at it and we were like, great. We recognize this. You know, we understand this looks just like what we're used to seeing in multifamily.
How many units in that property?
That property was probably about 500 units or so, 500 or 600 units.
Okay, so a fairly good size property.
Yes. But they hadn't, they hadn't, not only did it look distressed, they hadn't leveraged parking very well. So they had, it was a typical configuration that you would see when you're driving by a self-storage facility, aisles of self-storage, and then the ends had parking available, but they hadn't striped it. They weren't leveraging all the parking space that they had. And another funny example is we walk in, we're talking to the manager, and the manager goes, you know what, I really wish I had a lot more 10 by 10 units available, because those are selling like crazy right now. And we're like, well, what about the 10 by 20s that we saw outside? Oh yeah, we have some vacancy on those. And we kind of look at each other like, well, why didn't you just put a divider down the middle of the 10 by 20s and charge higher rent per square foot, which is exactly what we did when we took over the property. Here's another great example too. We go to the property, we walk in, and we're like, this building looks like climate control building. Oh no, there's no climate control in this building. But you could tell it was a mirror image of another building there that had climate control in it. We're like, why didn't you put AC on this building? Oh, I don't know. When we came in, it just wasn't climate control. And we were able to convert it for $25,000. We were able to put HVAC on that large building and convert it to climate control because the rest of the building was ready for it. So it was a perfect opportunity to come in. And not only that, the occupancy was low. And who wants to store their items in a property that looks where the manager's apartment has a broken window and you walk into the office and it looks like it's in terrible condition? So the occupancy was low and the rents were low as well.
So if you made this as a comparison to multifamily, have you seen a lot of properties on the multifamily side that were broken that you invested in?
Oh yeah, that was exactly what we would look for, right? And multifamily, that was the perfect opportunity. If we drove up to a multifamily property and it was in beautiful condition and high occupancy and high rents, that really wasn't what we were looking for. Because we want a property with a value add component to it because it gives us more upside on the returns and it gives us protection in the future as well.
So the transition really from multifamily to self-storage is a pretty close comparison because you have a value added property. You could have lots of deferred maintenance that you have to cure. You could take a property that was not climate controlled and make it a climate controlled. And so you can start pushing your rents up fairly easily if you invested some dollars correctly, just like on a multifamily property, to push rents up.
Exactly. It's NOI. These properties are valued based on the NOI that they generate, the net operating income they generate. The market puts a cap rate on that just like they do with multifamily. And so the opportunity is to go in and look for ways to increase that NOI so you increase the value of the property.
And these properties that you guys have invested in the past, in comparison to apartments, would these be B and C self-storage, or would they be A self-storage? Give me kind of paint a picture in somebody's head what it's going to look like.
Yeah, the ones we bought have looked I would say they were more Bs when we bought them, maybe even B minuses or C pluses just because of the deferred maintenance component. But when we go in and paint these and fix the offices and rehab them, which doesn't take a lot of money, by the way, because these are, in an apartment complex, you might spend quite a bit of money to go rehab the exterior, to go in and add amenities, to go upgrade the units. It can be expensive and it can be time consuming. Well, for self-storage, it's not as difficult. These are metal boxes. You might have to cut out some metal that's rusted and repair that, but more along the lines of a paint job than the rehab that we were used to on multifamily, which is nice because we can do it quickly and we don't spend a lot of money. But yeah, we can go in and do similar things that we did in multifamily to repair the deferred maintenance on these properties and bring them up. So in multifamily, we might try to take something from a C to a C plus, or it's hard to go maybe between a whole new level of class in multifamily. But in self-storage, we can go and buy a B minus and convert it to an A. It will look brand new. When you drive up to the properties now, they look like they were just built because anything that you saw on the outside was repaired and repainted. The roads were redone and it looks brand new. Otherwise, it's a metal box. It looks brand new.
So when you're buying these properties, are they typically in industrial areas? Are they in residential areas? What type of an area are you buying these type of metal boxes in?
Well, the ones that we bought have been more residential. You want to be near residential. You want to be near apartments, places where people don't have the space to store, which is one of the demographic shifts that's helping self-storage as well. Because, as you know, the apartment market is very hot. More people, home ownership has hit its lowest level possibly ever in the United States, pushing more people into rental housing. And in rental housing, there typically isn't as much space available. So that's one of the areas that's helping self-storage.
And then when you guys buy the property itself, are you guys the managers of the property, or do you go out and hire third-party property management like you would in an apartment building?
Right. We are partnering with operators typically, and they are the ones that are running the property. We are involved in the acquisition of the property, selecting the property, buying the property, funding the property, overseeing the management of the property, but we're using other parties to manage the property.
And then when you guys are buying, you're buying a lot of these properties are mom and pops. When I think of a self-storage facility, I think of public storage or some of these independent REITs or family offices that may own thousands of properties or so. Hans, in your mind, if you can tell me, what is the percentage of owners like you guys versus the REITs?
There's probably about 25% of the market is owned by REITs like Extra Space, Uncle Bob's, Public Storage, those types. And the rest are 75% or so are either mom and pop or regional or owners such as ourselves.
Wow. So that you're playing in a big space that has a lot of independent ownership groups in it.
Correct. And that's the opportunity we see.
I see. Now, is there a big pricing difference? I don't know if you guys have done pricing comparisons between, say, self-storage and your facility. Are you guys pretty much on the same par, or how is pricing determined in the marketplace?
Same way as apartments. It's as Doug mentioned earlier, it's based on NOI and cap rates. The REITs are buying their properties or would be selling their properties in a little bit lower cap rates than, say, the mom and pops, and it's really valued exactly the same way. And in fact, that's one of our exit strategies, is to fix the property up, put an apartment on site if there's not one, fix the office up, add curb appeal, and then sell it to an Uncle Bob's or an Extra Space Storage for a lower cap rate.
So that's really what isn't a possible exit strategy is.
It's a possible exit strategy. I mean, our first goal is to create cash flow and fix it up and draw a better demographic and a higher paying tenant. But our exit could be to REITs, because the industry has been consolidating over the last 10 years, and the consolidation has started speeding up in terms of REITs buying up properties.
So take me through just kind of a typical transaction where you guys found a property and you guys wanted to buy it. Kind of walk through me. You guys got on property like this one with the bad couch. Tell us the backstory of how that transaction got done. How did you find the deal?
One of our strategies has been, when looking at new segments, to invest there personally ourselves. Obviously, we're researching it a lot too, but by investing in it, we get a little bit more visibility into the nuts and bolts of what's going on. And it turns out that one of the investments that we had both invested in, actually, with a certain operator, that as we did due diligence on them and got to know them, they said, "Hey, we have some opportunities available. Take a look at these and see what you think." And these first two opportunities, we took a look at them and thought, wow, this looks a lot like what we've been doing in multifamily. It's a different space, but we understood how the value was going to be created, how they were going to turn that property around. And the due diligence looked very similar to multifamily.
So you underwrite it similar.
That's right. Yeah, different cap rates, right? Or not. In this case, they're actually not that different from multifamily. But yeah, I mean, the rent growth, one of the advantages of self-storage over multifamily is that rents are a little less sensitive to changes. So for example, if I'm in a unit and I'm paying $50 a month and the operator comes to me and says, I'm going to increase rents 10%, which sounds just incredible on the multifamily side, right? Yeah. But in self-storage, if they come to you and say, I'm increasing your rent $5 a month, I have to decide, well, first of all, I'm probably thinking to myself, I'm not even going to leave my stuff in there that long, which isn't true, because people do leave the stuff way longer than they think they're going to. And second, if they think even if I am going to stay there, I mean, what's my cost to try to pull everything out of there, drive down the street to another facility and put it in there? So, you can make 10% rent increases on these properties without having people move out right away.
So I think a lot of people are wanting to know what happens with the stuff when the people stop paying and you guys take that stuff over. Am I going to see you on a television series about self-storage wars?
We've not been on storage wars yet. But as you can imagine, I mean, it gets auctioned, as everyone probably knows from seeing those TV shows. So, you have to lock it. It's just like a multifamily. You have to give notice, and there's a process that you have to go through to get them out. And eventually you'll auction that.
All right, we took a curve. Let's get back to trying to put the deal together. So first of all, you researched it. You helped some information to get from an operator that's currently in the business itself. You guys put invested in with them.
Right. And you can imagine it looks very similar to due diligence on multifamily. What does the market look like around it?
Sure.
What's the occupancy? What are the rent levels, that are in that submarket? It's all about the submarket. What's the submarket like? Is that an area that's on the decline or is it improving?
I think one thing to add on that is supply tends to be almost a bigger, knob in terms of research on your due diligence for self-storage than it even is for multifamily. Multifamily, you look at submarket occupancy, et cetera. In self-storage, we typically do a study of supply of self-storage within a 1 to 3 to 5 mile radius. And then there's national indicators that we use, just like there's multifamily research, there's self-storage research. And there are basically indicators we use that says that everyone in the U.S. needs about 7 or 8 per person per square foot storage, something along those lines, I believe. And we use those indicators to determine if supply is over or undersupplied in the market.
Yeah, and otherwise it's very similar. I mean, who is lending against it? Similar lenders. We don't have Fannie Mae. We don't have the government agencies in self-storage, unfortunately, but we do have, there are banks, there's CMBS is a very active lender there. It can also be life insurance companies, which we weren't used to seeing so much on the multifamily side, but we do see more on the self-storage side.
So what kind of leverage can you get on something like that?
Typically, you can get 75% or so on self-storage depending on the deal, but it really depends on what kind of lender you go with, number one, and then the type of deal it is. But you can get close to 75% or so. It's not quite as high leverage as you would typically see in multifamily.
Because
one, we don't have agency debt. In other words, there is no Fannie or Freddie lenders or opportunity to get that kind of debt in self-storage.
But you still can do CMBS loans, which can and are going to be non-recourse transactions.
That's correct.
Okay. So
and life insurance is non-recourse as well. Typically a little bit lower leverage point, though.
Right. So continue to walk through me when you see this deal with the couch, and you guys said, this is an opportunity. Tell us a little bit about, did you guys research the area? Was it brought to you by a broker? How did you guys?
Yeah, so we did research the area. Just as we mentioned, who are the competitors? There's a 5 mile radius, which is your competitive area in self-storage. So who are the competitors in a 5 mile radius? What are their occupancy levels? What are their rent levels? And how do we compare? And what we saw with these two properties was they were significantly lower rents in that area, and they weren't, and this significantly lower occupancy as well. So it's exactly what we would see, in the past in a multifamily deal that was distressed. We'd see lower occupancy, we'd see the lower rent. You would see, what are the 4 or 5 properties in the area right around it achieving? And if they're achieving the higher rents and the higher occupancy, why am I not? And once we drove onto these properties, it was clear why they weren't achieving the higher.
A lot of similarities between multifamily and self-storage, you're telling me.
Absolutely. So it felt very natural for us looking at that segment, multi-tenant as well. So, versus like a retail environment, where there might be a single tenant. So you had the advantages of that as well. So you're never going to have your, 75, 90, 100% of your base move out, at one time. So that part was also similar.
So when you're buying a property like this, what is your typical occupancy when you get it? And then what's a stabilized occupancy for you guys?
Well, nationwide right now is 90% is about the average. And if you look at the REITs, the bigger players in the market, they're at 5 to 6% vacancy. So they're at 94, 95% occupancy. When we bought those facilities a year ago, we were in the low 70% range on occupancy. Now, everything is submarket dependent. I mean, that's just the national average. And those particular submarkets tended to mirror the national average. So they're about 90% occupancy as well. And so the one that we bought that had the disaster couch in it,
sure.
That one we turned around and it's been in the upper 90s now in occupancy. And the other facility I think has been in the mid 80s. It's in a slightly different area. But another interesting piece about the first is our partners who are managing the deal had turned another facility around. How far away is it? Maybe half a mile away from that facility that they sold to a REIT. Then they came in and they've repeated the same thing just down the road. So now they've taken that property, and we haven't talked about selling it yet because really our goal is cash flow. But in this market, who knows? Maybe we'll talk about selling it as well. But they implemented the same strategy. We've come in, increase the occupancy, remove the deferred maintenance, add the ancillary income from U-Haul, stripe more spaces to improve. I would say that's one of the differences with self-storage. We can come in and add parking. We can add units. You're not really adding units that often in multifamily. But in self-storage, we can come in and add parking. We can come in and cut units in half and say, we're going to add, we're going to separate that 10 by 20 into a 10 by 10. Or we can just take the raw land in the back, and expand it, which is another thing you can't really easily expand. In a multifamily that you're buying that's a 70s asset, you're not typically going to add on 30 units in the back at today's, at a brand new construction onto that older facility. But we will do it, and it's easy to do in self-storage.
And one other thing that you can do in self-storage that isn't as typical in multifamily is your ancillary income. In self-storage, there's up to 40 different income streams beyond the rental storage income that you can create, such as selling boxes, retail, U-Haul, renting trucks, etc.
So I've seen apartment buildings become self-storage. And Hans, you're supposed to say, well, how does that happen?
How does that happen, Paul?
Is when the chiller goes down and it becomes these nice hot boxes and all the tenants go away, but their other materials stay in the units, that becomes self-storage pretty easily. So let's talk about climate control type of stuff. That's kind of the wave of the future, or is that typical on a lot of these buildings is climate control? And what is the percentage of climate control to a typical piece? Is it a third of the building should be climate control, 2/3? I mean, what's a rule of thumb if there's a rule of thumb on climate control?
I'd say it's probably more sub-market dependent, than a general rule of thumb. Most of our facilities are in Florida, and there, it's more humid and it's hotter, and so the climate control is a little bit more popular. We're expanding, one of our facilities in Florida right now, and we're expanding at 100% with climate control because that, the premium that we're getting is 30-40% on top of the non-climate control. The expenses, when you look at, what does it cost to run non-climate versus climate? Well, we already have the staff on site. That's not going to change. There's a little bit higher utility, but surprisingly, it doesn't consume a lot of electricity for these climate control units because you're not keeping it at 65 degrees. You're keeping it at 80 degrees, and you're not keeping it at 80 degrees in the winter. You may be keeping it at 60 degrees or in the 50s in the winter, and you're not using huge air conditioning units as a result. So it doesn't cost a lot. We converted one of the buildings at a facility from non-climate to climate, and actually in that case, it was just adding HVACs on the building. This new facility that we're expanding, it's going to be climate control. But the point I'm making is you get a lot higher rents for the climate control, but the annual expenses are not dramatically higher. The primary, I would say, downside, the reason you wouldn't make everything climate control is the buildings aren't 100% efficient. If you're in terms of space, so if I'm building a climate control building, I need hallways, there's wasted space, there's an elevator. Whereas if it's a non-climate building just sitting on the ground, I get 100% use of the space. There's no hallways. It's just a drive-up facility. Well, there can be non-climate inside as well, but if you have a drive-up self-storage space, you're using all of the space. So every square foot that you build, you're getting 1 square foot of storage. But to go back to your original question, it really depends on the submarket. I would say in Florida, we're seeing the climate control is very popular. In areas that aren't as hot, they may not have as much, climate control, or aren't as humid, may not have as much climate control.
In the facility that Doug is speaking of, we're 100% occupied in our current climate control building, and our non-climate is still highly occupied, in probably mid-90s, but it's not quite as high occupied as climate control, and that's one of the reasons we decided to move to full climate on the expansion piece.
But you guys are not building new facilities. You're just looking for inefficiencies in the market, just like you would on multifamily, and capturing those type of properties. But properties that have been in the ground for maybe 10, 15, 20 years or so, and just tweaking it with an ownership that maybe has created a lot of deferred maintenance in the property, does not have the right management group that's pushed into the property itself, and then you're just looking to take advantage of that opportunity.
That's right. There is an opportunity with buildings that are performing well, by the way, and that opportunity right now at least is expanding the facility. So if if I pay the price for that facility and I'm coming with a bunch of vacant land behind it that's included for free, so to speak, because I'm paying for it already with the existing structure, I can expand onto that facility, and that's actually, there's some really nice economics behind that, because if you go build a brand new structure from scratch, well, I have no income coming in for the first, however long it takes to get the plans done, the permits approved, the structure built. Then I have to lease from zero occupancy all the way. It's like building a new multifamily or development. But if I can buy a facility that's already running, well, now hopefully I can have that facility pay off my debt service on the loan that I get, and I can go expand. And I'm not paying any interest out of pocket, and I'm probably making a profit off of that initial facility too, while I build the expansion. So Hans and I, our goal is to be in the double-digit cash flow as fast as possible. If we go build a new structure, it might be year 3 or year 4 before we get into double digits, and we've had all that first three years that we've had no return at all. But if we go into an expansion type scenario, we can possibly be double digit just off the existing structure, and the new structure is going to take us even stronger into even higher in the double digits and get us even higher on the exit.
Yeah, so you guys own 1,500 self-storage units throughout the United States. Tell me a little bit about this last transaction that you guys closed, and when did you buy it, and then what are you doing to it right now?
Well, we purchased a facility approximately a year ago. It's in Naples, Florida area. And
that's a good area.
Naples. It's a very high income area. In fact, we are across the street from a multi-million dollar development that was one of the reasons we like the area. There's not a lot of supply there. In fact, the area down between us and the island where we're near is banned from any more building, because I think it's either some sort of a park or a ecological area that the state of Florida isn't allowing any more commercial development. So it offered an opportunity to get a self-storage facility that was in high demand that wasn't going to have new supply built right next to it.
So what did you guys do to this property?
Well, similar to what Doug was speaking of, we cleaned up this property as well a bit. But we really went into this property with the thought process of doing an expansion, as Doug has been speaking of. And the beauty of it is, just like what Doug just covered, is that the loan that we would need to do our expansion, which is about a $3.5 million expansion, the loan could be covered by the current income of the property. So that makes, as you know, Paul, lenders very happy when there's already income that can cover the debt for a loan.
Oh, I like that.
So we bought the property and basically use the lender that was on the property at the time, let us assume the loan, and with a plan to refinance into a bank loan to get an expansion piece as well on top of the refinance. And that's what we just closed last month with a lender here at Old Capital.
So what kind of rehab are you guys going to do to the property?
We're going to do an expansion piece on the property. It's about a $3.5 million expansion, give or take. It's in Collier County there in Florida. It's a long process. It's about a 9-month process to get permitted. So it's something that we really had to juggle in terms of timing with the lender and the expansion piece itself. But it's about a 30,000 square foot expansion to add mainly climate control.
Wow, so that's a large expansion.
Yeah, it's decent. It's a decent size expansion. It's going to be 2 or 3 story. We haven't decided yet. It'll be towards the back of the property, so it'll create a nice backdrop for the property itself. And the drive up and curb appeal will be improved, and it will be more of a REIT type property that we could possibly exit in a few years.
That's great, Doug. What else is on the horizon for you guys?
Well, we're continuing. We like the self-storage space. We're continuing to look at opportunities there. I would say more expansions than anything else at this point, or those are the opportunities that we're seeing the most. And we're also continuing to look for any cash flowing type of real estate. It may be self-storage still, or we may look at other types of commercial real estate that have that value add cash flowing property.
But you haven't given up the multifamily, because you guys just closed another multifamily deal.
That's right.
Last month too.
That's right. We just acquired 152 units over in Mesquite, another value add deal, a deal where the rents were 10% below market. They hadn't gone in and done any upgrades yet on those units. So that's the common theme in what we're doing. We're looking for value add real estate where we can come in, and it's all, you have to buy those properties at the right price. You can't pay any price, and that's part of what got us into self-storage to begin with was there was so much competition for the not a lot of units available in multifamily that we started looking at other asset classes for more opportunity. But you'll see across all of our purchases that there's a value add component and a strong cash flow component.
So, I think that was really the purpose of our conversation today, is just kind of understand a little bit about some of the inefficiencies in the market. It's just not multifamily, but it also is self-storage. And you guys have done a great job of kind of bringing these Humpty Dumpty self-storage properties back to life again by, taking for properties like you said, with the old couch and the broken window and needed to be paying, and somebody hasn't put any capital into it for 12 years. And you saw in the market itself that, rents were low, and that if you just put some money into the deal, reposition the asset, that this could be a home run type of a deal.
Right, exactly. That's exactly right.
So, I think for somebody that is not into the multifamily space, but is thinking about the self-storage space, I think you would want to think of it as a complementary business. That's the reason why I wanted to kind of get Doug in here and Hans as his partner, and kind of just explain really what the idea of what this different asset classes is all about, and how close and similarity it is to our multifamily business that we do quite a bit of. So if somebody wanted to get a hold of you, Doug, and talk a little bit more, again, what's the best way to get a hold of you, Doug?
Sure. So you can see more about us at our website, which is www.boxwilson.com. That's boxwilson.com. You can also send us an email, manager@boxwilson.com. will come to both of us. And there's contact information available through our website. So if anyone wants to learn more about us, check us out there and drop us a line. We'd be happy to meet and tell you more about what we do and any upcoming opportunities we have.
That's great. Again, there's no financial carrot to Old Capital. I mean, I just wanted to get you some education about what's going on in the self-storage business and how close it is to the multifamily business, and so everybody can understand that. But we do appreciate both you guys coming in. Thanks for spending some time with us in the podcast. Thank you.
Thank you.
Thank you.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.